Well, welcome to Chapter 18, Tools of Monetary Policy. And in this chapter, we're going to examine the major tools used by the Federal Reserve System that control the money supply and interest rates, basically monetary policy. We have a few learning objectives. One is to really explain how the Federal Reserve currently implements monetary policy. Talk about and explain the key monetary policy tools that are used when conventional policy is no longer effective. So we'll look at a couple of crisis situations and then identify the distinctions and similarities between monetary policy tools of the Fed and those of the European Central Bank. Now, important to recognize here that the material on this slide and the next few slides are really updates of things that have occurred since the book was published. So really, since our textbook was published, the Fed has changed how it implements monetary policy. As I say, the Federal Open Market Committee still meets and sets a target range for the Fed funds rate, and the Fed funds rate is still very important, but really how they control the Fed funds rate and that target rate is what has changed. The Fed no longer relies on open market operations to influence the Fed funds rate. And actually in March of this year, it reduced reserve requirements to zero. So in essence, we've gone from kind of a limited reserve or there was a 10% required reserve ratio. Now that's gone to zero. And there's really ample reserves in the system. A lot of that's occurred since they've started paying interest on reserves. And so they've gone to a little different policy in terms of managing that Fed funds rate. So today, the Fed influences the Fed funds rate using three rates that it sets: the discount rate, the interest rate on reserves, or IOR, and the overnight reverse repurchase agreement rate, or is referred to in short, the ONRRP rate. And that is really, we'll talk about that, that's a rate that they, rather than paying it on reserves to banks, they pay it on money given to them by non-bank financial institutions like large money market funds and some of the government agencies like Fannie Mae, Freddie Mac that are involved in the mortgage market where they offer mortgage-backed securities. And we've talked quite a bit about those already this semester. So it's important to recognize when you look at our text and it talks about open market operations and buying and selling treasuries to influence the Fed funds rate, most of that has really gone away. And now the Fed, rather than relying on open market operations, relies on those three rates: the discount rate, interest on reserves, and the overnight reverse repurchase agreement rate. All right, so in talking about those three rates, the discount rate, again, is the rate that banks can borrow directly from the Fed at. And that discount rate really sets the ceiling for the Fed funds rate, because banks are not going to pay to borrow funds at a rate higher than they could get borrowing directly from the Fed at its discount window. So that, in essence, sets the ceiling for the Fed funds rate, recognizing, hey, we could borrow directly from the Fed at whatever rate that is. Say it's set at 1%. We can borrow from the Fed at 1%. We aren't going to go somewhere else and pay a rate higher than that when we can go directly to the Fed. So I'm not going to pay a rate, if I'm a bank, I'm not going to pay a rate any higher than that discount rate in the Fed funds market. You'd borrow directly from the Fed rather than paying a higher rate buying from or borrowing from another bank. Now, the second rate, the interest on reserves, or IOR, sets the floor for the Fed funds rate for banks, since they can earn the interest on reserves risk-free at the Fed. So again, they aren't going to lend in the Fed funds rate at any rate lower than what they can get from the Fed risk-free. So, I mean, if they can, in the Fed funds market, if they can get a rate better than the Fed's going to offer, they could do that, but they aren't going to go any lower than the interest that the Fed is going to pay on reserves. So that sets the floor for banks. But as the third bullet point points out, not all participants in the Fed funds market are banks. There are also some federal agencies, some of those agencies that are involved in particularly the mortgage market and issuing mortgage-backed securities, Fannie Mae, Freddie Mac, Ginnie Mae, those large federal agencies, as well as large money market funds that can borrow and lend in the Fed funds market. They are not eligible to get that interest on reserves rate that banks get. So when you talk about the floor for the Fed funds rate, that IOR, or interest on reserves, is really kind of, you can think of it as a soft floor, that's the floor for kind of banks. But for other participants that can't get that interest on reserves because they don't hold reserves at the Fed, then, and aren't eligible to, they can't get that rate, and thus we'll see that the Fed funds rate for them can actually be something lower than that interest on reserves. And as we go on to how it can be lower, well, the Fed allows non-bank institutions to earn an overnight repurchase agreement rate that, in essence, they'll pay them for depositing funds at the Fed this reverse repurchase agreement rate, which actually sets the overall floor for the Fed funds rate, or it's really the floor for non-bank institutions. And it turns out to be the overall floor for the Fed funds rate because it's set below the IOR rate, or interest on reserves rate. So for non-bank institutions, the Fed says, we'll pay you this reverse repurchase agreement rate, but we're going to set it slightly below the interest on reserve rate that we offer to banks. So it ends up that this interest on reserve, when we talk about all the parties that are involved in making up the Fed funds rate market, since some of them are non-banks, that actually becomes their floor rate of the interest paid on overnight repurchase agreements, is the ultimate floor for the Fed funds rate. And as I have to illustrate this, as of the most recent meeting of the Federal Open Market Committee, they set the Fed funds target range somewhere between 0 and 0.25. So that was the range they said. You want to try and keep it in that, with 0 being the floor and 0.25 being the ceiling. And they set the discount rate at 0.25, which we said would, in essence, serve as the ceiling for the rate. They set the interest on reserves at 0.1, and the overnight reverse repurchase agreement rate, or the ONRRP rate, at 0, which matches right up with their range of, that's the floor, the overnight reverse repurchase agreement. That's the floor for Fed funds set at 0. Discount rate, which is the rate where banks can borrow from the Fed, at 0.25. That's the ceiling, and that interest on reserves is a little above the overnight repurchase agreement rate at 0. So the floor for banks is slightly above the floor for non-banks, and thus that Fed funds rate is going to fluctuate generally between 0 and 0.25. Now, during normal times, raising and lowering the Fed funds rate is the primary monetary tool utilized by the Fed. If they want to slow down the economy, then they'll raise interest rates. That'll help usually keep inflation under control. If they want to spur the economy on, create more jobs, and kind of get the economy moving in a positive direction, then they'll lower the Fed funds rate, which helps to lower general level of interest rates and create more economic activity. And though, actually, before we get to talking about the stronger measures, I do have this slide on discount policy and the lender of last resort, recognizing that in addition to standard monetary policy, the Fed does have a policy of this discount window and making loans to banks where they can borrow directly at the discount rate. Now that, as I said, serves as the ceiling for the Fed funds rate, but generally they want the banks borrowing from each other, and generally the Fed funds rate is going to be below the discount rate. So rather than borrowing from the Fed, banks are normally borrowing just from each other, the Fed funds market, and other participants, some non-banks, which we already discussed. Generally, if they're borrowing from the Fed directly, they're going to borrow at the primary credit rate. That's basically the standing lending facility at a rate slightly above Fed's target rate, or at the high end of the target range. There's also a secondary credit rate available for banks that are in trouble, and usually the secondary credit rate is a little higher than the primary credit rate. This is in situations where the banks are really having some difficulty and have been identified as more of a troubled facility, troubled bank that is a riskier loan for the Fed, and thus they're going to charge a little higher interest rate. But overall, this Fed lending policy creates a little bit of a safety net for the banking system, that they serve as this lender of last resort. And at times they've stepped up big, particularly in times of significant financial crisis, where they've said, hey, we are willing to stand behind and lend to all banks that are in a difficult position right now. And this certainly occurred back in 2008. And we've talked about this points out that it creates a moral hazard problem that potentially with the banks, and particularly the large banks, knowing that the Fed is there to bail them out, allows the possibility that they might take on more risk knowing that they're going to be bailed out if things go bad, and thus has potential for a moral hazard issue where banks are behaving a little bit more recklessly, knowing that the Fed is standing ready to prop them up if they run into serious problems. But overall, it does provide a level of stability to the whole system, having the Fed there as a place that troubled institutions can turn to, rather than just having to go into bankruptcy and potentially failing when, if they had some source of a loan to get them through a rough period, they maybe could have made it. So that's one of the positives of having the Fed there to serve as lender of last resort. Now, going to the situation again of the Fed and some of their policies, unusual situations where things have gotten to a point that standard monetary policy was not enough, and that just lowering the Fed funds rate, for instance, to help spur the economy on or to stabilize things, was not going to be enough on its own. You can take a look at what happened in 1987, where in October 20th, 1987, there was a significant, huge one-day drop in the stock market, which caused a serious amount of concern in the financial markets. And the day after that, the Fed came out with a statement saying Federal Reserve was ready to serve as a source of liquidity to support the economic and financial system. And this was something at the time was a fairly extraordinary announcement. They made it clear that they would provide discount loans to any bank that made loans to the securities industry, because there was a lot of problems that arose because in many cases some stocks fell by 30-40% in one day, and for those that were invested in some of those, and some of the players in the stock market took major hits and created a great deal of concern and instability in the markets. And the Fed kind of said, we're ready to stand and try and provide some stability and loans to some of the parties to get them through this rough period, because the chances are the market is going to bounce back from this, if not in the next few days or weeks, somewhere in the not too distant future. And in fact, that's what happened. That while the markets dropped dramatically that day, they recovered a lot of those losses over the next couple of months. So it wasn't that long before things were back to a level similar to where they'd been prior to that major drop in October of '87. And in hindsight, that Fed's action likely helped to avert any type of financial panic. Now, when we talk about the part of the reasons why, or some of the reasons why conventional monetary policy has problems in a true financial panic situation, when the economy does experience a crisis. Often conventional monetary policy just isn't enough. And first of all, as is pointed out, the financial system seizes up to an extent that it becomes unable to allocate capital productively, and you end up with a major drop in investment spending. The economy will often drop dramatically. You'll have GDP fall, unemployment skyrocket, and be in a position where just lowering the Fed funds rate by 1%, 2%, or something along those lines is just not enough to counteract what's going on. Also, it takes usually a number of months for that really to have an impact, and often in a crisis situation, you need something that's going to calm the markets and move in a more, in a much quicker manner than traditional conventional monetary policy. So that's one of the problems, that just lowering the Fed funds target rate certainly helps a little bit, but is often not nearly enough to handle the magnitude of the problem. Secondly, a negative shock in the economy can lead to this zero lower bound problem. And talk a little bit about that. That's the idea that you can lower the Fed funds target rate only so far. And we're there right now. I just talked about the most recent meeting of the Fed, where the target range right now is between 0 and 0.25%. So we're there. We're at a point where they've gone down as far as they can go in that target rate for the Fed funds rate without going negative, and they've never historically gone negative, and they probably, from anything I've heard, are not planning on going negative anytime in the near future. So what happens there is you lower the Fed funds target rate, and sometimes this can happen, and it happened back in 2008, where the Fed funds rate had been up at 2-3%, and they brought it down, and even after bringing it all the way down to 0, it still wasn't enough to really deal with the magnitude of the recession and the resulting high unemployment and difficulties that the economy was having. So you have this zero lower bound problem. The Fed doesn't want to have the Fed funds rate go below 0, so you're stuck that you've lowered the Fed funds rate as far as you can, and now what? And so that's where you get into the unconventional monetary policy, and that's where we'll talk about you can look at things other than changing that Fed funds rate. So for non-conventional monetary policy tools during 2008, as I mentioned, they had the Fed funds target rate down to basically 0, and still were having difficulties. And so one of the things the first one, the liquidity provisions, implemented unprecedented increases in lending facilities to provide liquidity to the financial markets. They expanded the discount window, lowered the rates on their borrowing rate for banks, and said, banks, you're welcome to borrow as needed without any questions, kind of in our discount window. They had term auction facilities. Again, that was borrowing for banks, and various lending programs for banks and non-banks, which we'll talk in a little bit more detail about in an upcoming slide. But they made a bunch of different lending facilities available to various parties in the financial marketplace, banks and non-bank enterprises. Now, they also came through with large-scale asset purchases, basically 3 new purchase programs to lower interest rates for particular types of longer-term credit. So they got into determining that, hey, they had lowered the Fed funds rate as far as they could, and so their short-term overnight rate for banks was down basically at 0, but even though they'd lowered that down, mortgage rates were still up at like 5% or something like that. So they said, what could we do to help lower the mortgage rates and some of the longer term rates? Because we've lowered the Fed funds rate as far as we can, the short term rates down, but some of those some of the longer term rates were higher. So they started purchasing longer term government securities, basically 5-year treasuries, 10-year treasuries, and since those rates are kind of set in the open market, by buying more of those rates, they help to lower those interest rates for kind of intermediate and longer term rates, which helped to lower interest rates for longer term securities and longer term loans to businesses and individuals. Also, they tried to bring the mortgage rates down by buying mortgage-backed securities issued mainly by government agencies. And so they bought government-backed securities where historically they had just bought treasuries. They started buying mortgage-backed securities as well. And it was estimated that that helped to bring mortgage rates down by around 100 basis points, or by about 1%. So those additional asset purchase programs help to bring longer term interest rates down, as well as the Fed funds short term interest rate. Now, this figure 7 is an important and I think interesting graph showing the Federal Reserve assets, total assets, and how up until fall of 2008, the total Federal Reserve assets were historically under $1 trillion. So, and that, if you go back 20, 30 years, that line, kind of the straight line from 2007 into the, as I say, fall of 2008, historically, the Fed had assets under $1 trillion, meaning their holding of, and that was primarily their holding of government securities for their, basically dealing with their involvement in open market operations. Well, we know in October of 2008, in response to the financial crisis, they started making a lot more loans to bail out banks, and just made other lending, which we've just been talking about, made a lot of loans available to banks and non-bank. Well, we'll talk about even insurance companies, but other non-bank organizations that needed assistance during that crisis period. And so we saw by 2000, even beginning of 2009, that the Federal Reserve assets were up around $2 trillion. And then from there, we can see how the line continued up to around 2015, and that upward movement included some of those quantitative easing or purchasing of longer-term assets, longer-term treasuries, and mortgage-backed securities. So that's where the Fed, in kind of that unconventional monetary policy, started buying those longer-term securities to bring interest rates down and help spur the economy on. So basically, after 2008, the economy stayed in a recession for a number of years. And even through 2000 into 2014, they were still buying securities trying to lower interest rates to spur the economy on. So there was like 5 years there of kind of non-conventional monetary policy where the Fed was trying to get the economy moving in a positive direction, lowering interest rates, trying to continue to lower mortgage rates so that more people could purchase homes, which helps to spur the economy on, and new construction and other activities, and also just the general level of interest rates, and particularly longer term rates. Anything that could be done to lower those rates, again, to help encourage consumer spending and business spending. The Fed was actively involved, and as we can see, their balance sheet went from under $1 trillion to over $4 trillion by 2015. And it stayed there at a pretty steady level, 2015 through 2017. They were starting to lower it down until, unfortunately, the beginning of this year, and the latest coronavirus problems, which has led to another significant economic downturn, and actions by the Fed to try and support the economy. So we're still at a range where we were starting to there, and there was an effort actually underway by the Fed to try and reduce their asset holdings and get back to a more normal level down around $1 trillion. But that's kind of been put on hold because of the challenges that the economy is facing right now. So as we talk a little bit more about the actions, those non-conventional monetary policy tools, quantitative easing versus credit easing, I think the point of this is certainly the Fed did become creative. They had never done any of this type of long-term asset purchasing, and some of the different lending facilities that they created in the aftermath of the 2008 crisis. But overall, they were trying to restore liquidity and lower interest rates. And when you talk about credit easing, their quantitative easing process, that process of purchasing long-term securities, the idea wasn't really that they wanted to increase their asset holding. It was they increased their asset holding to help ease credit issues. So I guess you could say that them purchasing those securities, it wasn't really the idea that they wanted to grow their balance sheet. It was really they wanted to lower interest rates. And to lower interest rates, they decided the best way to do that in those longer term interest rates was to buy mortgage-backed securities and buy longer term treasuries, and thus create more demand in that market, or really supply of funds into that market to help lower interest rates. So overall, and I think Bernanke said, rather than calling it quantitative easing, he preferred to call it credit easing. That really their plans and the reason they expanded their balance sheet was to ease credit and make credit more available and at a lower cost to individuals and businesses to help spur on the economy. A second point that they have here is that one of the things the Fed started doing was forward guidance, that once they got their, again, Fed funds target down to zero, they were stuck, that they couldn't lower it any further. But one thing they started doing was saying, not only is it at zero, but we see it staying at zero for quite a while. And until things really change, we're going to keep it at this level. And that was something new that they hadn't done historically. So by committing to this policy of keeping Fed funds rate at zero for an extended period, the Fed helped to lower the market expectations of future short-term interest rates, thereby causing long-term interest rates to fall. So they're basically saying, yes, interest rates are short now, or are low now for short-term rates, and we see them staying at that level for an extended period of time, to a point that our horizon, as we look out, we see rates low for quite a while. And that, sending that signal to the market, helped then people to start to say, well, then I guess I'll accept a lower rate for a 1-year treasury or a 2-year treasury, because the Fed is telling us they don't plan on raising rates anytime in the near future, and thus they're even saying 6 months to a year or something like that. So it helps the long-term rate to fall if the Fed starts giving this guidance of what they plan to do in the future, and kind of ease the concerns of the market that rates might go up. They're saying, nope, rates are at zero, and we plan on keeping them at zero for an extended period. And as I say, something that hadn't been done previously and was kind of a new, unconventional tool that they utilized. Now, as I've mentioned before, we get to negative interest rates on bank deposits. This is something that's was used in some other countries around the world, where they went to actually offering negative interest rates, and the central bank started to say, we're paying negative interest rates on reserves held at our bank by the central bank by other banks. And the idea there is to really encourage banks to hold as little reserves as possible. Lend out the deposits they were keeping at the central bank. And the idea is, if zero spurs the economy on, then negative rates could spur it on even a little bit more. However, as pointed out in the text, and really most studies that are done so far, cast some real doubts on whether negative interest rates on deposits have a real expansionary effect. And as I say, the Fed has steered away from getting into negative target rates for the Fed funds, and is saying it can go down to zero, and then we'll do other things, but we aren't going to move our target rate below zero. Now, when you talk about the Federal Reserve and a number of the things that they did in terms of new lending facilities, there is, a page in the text that outlines all the various new lending facilities that they came out with. We talked in the past when we dealt with the chapter on financial crises and talked about some of the things that happened in 2008. One was they did make a loan to AIG, large international insurance company that had significant exposure to the credit default swaps. They got bailed out because they were seen as kind of too big to fail. Also, there was a loan to JP Morgan that helped them to purchase Bear Stearns. And then there was a number of other lending facilities, and you've got the TAF and TALF, and those are various term facilities issued by the Fed or started up by the Fed from 2008 on to basically, and I'm not going to ask you to identify any one of those specific lending facilities or know what the acronyms are or anything. What I want you to recognize is just that some of them were for the banks, some of them were for money market mutual funds. There's one for actually even foreign central banks because of the global nature of the problem. They actually made some loans to some of the smaller foreign central banks. Investment banks that were impacted, government agencies, and they did quite a bit to bail out some of the government agencies that were involved in the mortgage-backed lending. So the bottom line is that they created a number of different facilities to try and backstop, again, the banking system and the related financial institutions, non-banking, that were at risk, particularly during the 2008 crisis. And a lot of those have kind of gone away now as things have stabilized, but they, again, were quite creative in creating some different ways to help restore liquidity to different parts of the financial system. The final slide of this chapter deals with the European Central Bank and some of the monetary policy tools it utilizes. And I will just tell you, I don't think I'm going to ask any questions dealing with the tools of the European Central Bank. I was just interested that you understood that a lot of the tools that the European Central Bank utilizes are very similar to what the Fed utilizes. Clearly, they utilize and have utilized open market operations. Some of that has been changed a bit in recent years, similar to what's gone on at the U.S. Fed. They also lend to banks throughout the European Union, some of the central banks at the different countries involved, and serve as lender of last resort. They also have had similar to the U.S. Fed reserve requirements. The U.S. Fed obviously, beginning of this year, reduced reserve requirements to zero. The European Fed, at least as of the writing of the text, was at 2% of checking deposits and other short-term deposits. But overall, you'll see that the European Central Bank is, in terms of their policy tools, pretty similar to the U.S. Fed. I say, I'm not going to hold you in terms of any questions for the final, anything specific about the European Central Bank and its policy tools. So I guess that pretty much wraps up the chapter, and I think that will end chapter 18, and we'll got one chapter left, chapter 19. I'll deal with that next.